If you have been in a situation where you predicted that the market is going to go up, and indeed the market went up, but before it went up, it stopped you out before, going into the intended direction you wanted the price to go, then this video is for you. Because us as traders, we have gone through series of experiences like this where the markets, your predictions were right, but you were not able to make money. At the end of the day, you lost money with the right prediction. So this situation a lot of times happens from the fact that, we as traders do not have the right positioning. Positioning and precision is very, very important in the market. Sometimes you're trying to buy at support, but your entry is not precise enough. Granted, we can't have the best. Sometimes you don't have the best precision. Sometimes you don't have the perfect setup, the perfect entry, the perfect sniper entry. But a lot of times we can compensate for that. If you have a sloppy entry, then you have to compensate for it with a stop loss that is good enough. I hear traders say this thing a lot, like, I have to set a small stop loss so that the markets so that I can have, a bigger reward. You need to understand that people participating in the market are erratic, just like me and you. We can be erratic sometimes. So a lot of times, institutional buyers and sellers want to get the best price before, price will go into the direction. So they bid the market down to the stop loss area so that they get a good price. When I mean the stop loss area, I mean like, let's say there's a support level. I'm going to show you all of this on the chart, but let's say the support level, there's a support level here, and you decide to buy, let's say, a little bit above the support level. Some institutional buyers that have good enough capital can bid the market down to, the bottom of the support, then they have a better price, then the price starts going up. So a lot of all of these things can lead to you having the direction right, but you're not in the trade. So come with me, let's get cracking on. I'll show you how you can get the best, the best entries, you can be precise, how you can position yourself even more rightly in the market. Let's get going. So in the market, situations like this happen a lot. Let's say this is I'm going to be using gold as an example here. So I'm going to be talking about my own personal experiences. So this week, I decided to sell gold at this particular level, right around here. So in the morning, so let's cut this out, because I trade London and New York session, London, New York, London session, New York overlap, and London overlap and New York. So that's about 3 sessions. So what happened was, I come on the 4-hour chart. First off, I need to see what's going on in the market. So I knew we had broken these levels here, so we're a bit bearish, because you can see this was the last. You always need to look at this place as how humans interact. So it's a couple of people, traders in the market, that decide to, this place is good enough for price to continue buying to the upside. So if you buy around here, following the trend that was already existing here, you can get a good risk to reward from this particular point. So as soon as price breached below this particular level, I started looking for sales. So I came on down to the 15 minutes time frame, and I started looking for where to position myself in this market. So look at it here. So in the morning, price, started coming back up. We started creating a little bit of higher highs on the lower time frame. You need to understand that the lower time frames are just for you to find entries, not for the direction of the market. So when I saw that we started having rejections around this level, remember that we are bearish in this market. So I started looking for ways to position myself to sell, because I was looking for sales in this particular market. This is on a Wednesday, the 4th of March, 2026. So on that particular day, my entry was very sloppy because I was quite busy doing other things. So my entry was sloppy. So instead of me to enter around these levels here, this particular price level around here, because this is 6 o'clock candle, that is London session open, and my stop loss was around this particular point here. So instead of me to enter the market right below here, set a sell stop right below here, since I missed that entry, I got in around here. So my stop loss has to be, big enough to cover up for the liquidities around here. So what did price do? Price indeed started moving in my direction. Okay, first off, it didn't move in my direction first, but it went all very close to my stop loss before it started going into my direction. It went in my direction for a while. Let's move it this way. See, after everything, price still went in my direction. This is what we're talking about, precision. Price still went in my direction, but I was not able to make money from this market. Why was I not able to make money from the market? Because my entry was sloppy. Sometimes you can get a sloppy entry like this, and price will still do its thing. But in this particular market, it wasn't the case. So now imagine I was able to get an entry around this particular point where I was looking for price. Imagine I was able to get an entry around there. You can see that I'll have, a good enough stop loss, and price will have gone to my, at least a 1 to 1.78, even a 1 to 2. I think this was, yeah, I was able to get at least a 1 to 2 on this, 1 to 9 point, yeah, that's at least a 1 to 2 on this particular price action. So this is the reason why we're talking about precision. Precision is very important because, if you're able to be very precise with your entries, you have a better risk to reward. But some of the notion I don't want people to focus on is, oh, I need to get a good entry so that I can have a very tight stop loss right around here. Let's say, let's go back to this bit. Let's go back to this bit. Let's say as price opened here, I was ready to sell. I sold around here and I put my stop loss right above this level here. What do you think price is going to do? Yes, if we take this out, you can see that this entry was very good. It's a very good entry. The precision was okay, but the stop loss to me is not okay now, because after so many times participating in this market, I've come to understand that your positioning is good, but you need to also give your stop loss good enough breathing room so that price can fluctuate. Because you need to understand that we as humans, whether institutional buyers, institutional sellers, the big banks, whatever, everybody is looking for a good enough price for them to buy, or buy or sell. So one of the big banks can decide to beat this market, sell it all the way, drive price all the way to this particular point around here, so that they can get a good price, then decide to dump on everybody. And imagine your stop loss is right around this side. Let's say you set a small stop loss around here. You see that price just moved, came, stop you out for no reason at all, and still went in your direction. See, price still went in your direction. So you need to understand that precision entails a couple of things. It entails you being, knowing where to position yourself, having a good enough stop loss so you don't get stuck or you don't get wicked out unnecessarily. Then also, giving your trade enough breathing room for it to do its thing, because the market at the end of the day is going to do its thing and people are participating in the market. So giving your stop loss good enough space, giving your trade good enough space, giving your trade ample enough space for it to do its thing, for the market to do its thing, is beneficial to you. Because imagine let's say you're trying to sell here and you're risking $1,000. Now price stopped you out and you decide to get in back again. Price decides to stop you out again. You're probably losing $2,000 for the same trade that if you have just set a good enough stop loss, you'll be there. This particular trade on that day, I didn't take any money from the market because since my entry was sloppy, the trade went on to, to become a break even. But if I was able to get a good enough, a more precise entry, let's say I was able to sell around this particular area. I didn't sell here because I was holding this trade, and I do not take two trades. I don't take another trade when the other trade, like the first trade I took, is not on break even. So that means I'm exposing myself. The exposure is too much. So I expose myself once and that's enough. So let's say I was able to get a good trade here. Let's say, because this particular price action was really beautiful. So let's say I was able to sell around here. This is New York session. I sell around here. If I'm taking this trade, I'm setting my stop loss enough here to cover for this liquidity around here. And I look for a 1 to 2. And this is beautiful. So these are the things you need to consider in the market. I'm going to show you an example of this particular trade, GBPJPY, because I bought GBPJPY on Friday and we hit a TP. So if you look at this particular market now, a lot of people may look at this market and be like, oh, why did you set your stop loss? This is a 45 pip stop loss. Why didn't you set your stop loss, as close to this particular point, like around here, so that you have a small stop loss and have a 1 to 3 risk to reward? I don't want that. Why? Because I don't know who is going to come to the market and beat the market up to my take profits, or beat the market, decide to sell the market. And somebody may decide to sell this market to this particular point just to get a good price at this particular week around here. I have tested this market time and time again, not just GJ. I've tested the market time and time again to be able to figure out that a lot of time this happens. Somebody may just come into the market because they want a better price and they have the capital to do it. They bid the market just to this particular liquidity around here, and boom, the market starts going up. So what happens to you? You have the rights that you have your what you predicted, the direction you predicted was right, but you end up getting stopped out. So the market is a place where it's an environment where a lot of people participate. Me, you, institutional sellers and buyers, banks, everybody is participating in the market, and everybody wants the best price. Me buying around this particular point because I feel this is the best price for me to buy. If I think price is going to come down to this point, I would wait. But I'm not certain that price is going to come here. So since I have my parameters, my requirements and everything, I beat the market, I buy. But there are people that have the liquidity enough, because I don't have the liquidity. You behind the screen as a retail buyer or a seller, you don't have the liquidity. So, you have to wait for the institutions to beat the market up or beat it down for you to get your TP. So an institutional buyer can decide to come down, feel like this particular price point is good enough for for its price, since it has the liquidity, and bid it, and price will still originally go to the original direction, but you're out of it. So you end up losing in the markets where you're supposed to make profit. So my advice to you is, give your stop loss, give your trade enough breathing room. There's no point trying to minimize your stop loss because you are trying to maximize your gain. It's a no-brainer to me to try to maximize my gain and minimize my risk, because this is a cushion for me. My stop loss level is a cushion for me. If price come to this particular point at this particular level, I know the direction may have changed. If price breach all the way to this bottom here, I know the direction may have changed. But if the direction has not changed, why will I allow the price to stop me out and go to the intended direction? It doesn't really make any sense to me. So as a trader, you need to keep, let's say, 3 things in mind: your precision, your entries, and your stop loss. You can do the best you can to get the best entries you can get, because wherever you decide to buy or wherever you decide to sell is where you think is the best place to buy. But that couldn't be the worst place to buy for an institutional buyer or a seller. An institutional buyer or a seller might decide that, oh, wherever you bought or wherever the market is, it's not good enough for him to buy because he has the money, he has the backing to do it. So give your stop loss, give your trade enough breathing room for it to do its thing. It is beneficial for you, it is beneficial for your account, it is beneficial for your psychology, because it doesn't make any sense for price to stop you out and go in your direction. You end up losing money for no reason. Take for example, like me, I have one short in a day. I take one trade and I'm done for the day. On the day trading point of view, I take just one trade. So when I take that trade, I have to make sure, like a sniper, I have to make sure that I do the best I can on that particular trade. So I have to give it good enough stop loss, do the best I can with my entries, because wherever I buy, I feel is the best place to buy. But like I said earlier, it might not be the best place for the next person or the next institutional buyer or next institutional seller to participate in the market. So it's best for me to cover myself, like give myself good enough stop loss, try the best I can with my entries, then allow price to do its thing. That's the best I can do. So use the weekend or take the time to backtest this. Always give your stop loss good enough cushion for it to do its thing. So come on, let's see something else here. If you look at this particular US oil here, look at where I set my stop loss. I set my stop loss this much, and I'm able to get my 1 to 2. The main thing is the market is going to move in the direction it's going to move. And once price starts moving up like this, everybody starts buying because they don't want to miss out. So everybody starts buying. So it's best for you to set a good stop loss to cover yourself so that market can still go in your direction without stopping me out. Imagine price decides to come a little bit lower. Let's say I set my stop loss around this level. Price decides to come a little bit low, grab this liquidity here and goes in my direction. But before it goes, it stops me out. And I'll be out of the market, and the market will still do its thing. So it's even more painful for you to watch the market do what you predicted it's going to do, then it stops you out before it goes in that direction. So when I was starting my journey as a trader, these are the things that I used to hamper my profits. So over the time, with time and experience, I've been able to notice that giving your stop loss, giving your trade good enough room for it to breathe is beneficial for you and for your account. So go home, practice, test this postulation I've just shared to you for free and see how it helps your trading moving forward. Don't forget to like, comment, share, because we're always here to give you gems as we are getting the experience from the markets firsthand. We share it to you so you don't have to go through the experience we have gone through. Don't forget to like, comment, share, and I'll see you in the next video. Bye for now.